So you have a real limit to how many dollars people can buy. So if the real number of dollars starts to go way, way down, then dollars necessarily, because there's a limited supply or a diminishing supply, then dollars will go up in value. So what does that mean? Well, let's talk about the interest rate cycle. If the Federal Reserve is raising their interest rate, what does that mean? Well, it means that you get more money for owning that particular currency pair. Why? Well, because a bank might pay you, let's say, 4.75%. So if you own dollars, you're going to make 4.75% annual interest on your money just for owning them if they raise interest rates. Well, what does that mean? It means because I make more money for just owning the currency, that means I want to buy it. So why is the British pound, in the 197 area against the dollar? Well, simply put, it's because if you own pounds, you're going to get paid 5.25% in pounds just for owning them. Just for sitting on your pound sterling, you're going to get paid this each and every year. Now, when you start to look at that in conversion to dollars, you're really going to get about 10.5% effective gross interest in dollars. So, what does that mean? That means I want to own pounds. Why on earth would I want to own dollars if I'm getting paid 4.75%? I know that's not the rate. Why am I going to want to own that? I'm making more money over here. And remember, we're talking about hundreds of millions of dollars. So even 0.25% is going to be a huge amount, let alone 0.75 or more of a percent or a full percent. Okay, so that's why you're going to have more demand. So how do we boil that down? How can we take that concept of supply and demand and attach it to our chart? Well, it's one reason why I like candlestick charts. Candlestick charts give me a very visual, easy to see representation of supply and demand. Now, it's important for you to not just focus on the body of a candlestick. Okay, that's what most traders do, is they're laser focused on the body. And that is a big, big mistake. You've got to be focused on the entire construction of the candlestick and what does that mean in terms of trading. So let's take some practical application now. Last week, the market, in this example, traded down. And this is not the current market, this is back in history. So last week, the market trades down. Coming into the next week, what happens? Well, here's your Friday break. The market continues to trade down over Sunday. In fact, it makes a double bottom coming into Sunday, or coming into the early morning hours of London trading. The market makes a double bottom down here and then starts to trade up. Well, when you're looking at price, especially on the weekly, you can see the momentum is down, it continues down, but then it gets reversed back up. So what we're going to do is we're going to take this, number one, in steps, and we're going to break it down into chunks and hopefully get into the flow of what happened in the marketplace. So as the market is trading and is moving down to this low, you can see what happens. Here's the first trading session of the week. And you can see this area here is lined up in this area right here. Okay? So you can see that from the prior Friday, the selling continued, popped up a bit, continued down, and then started moving up. And that's where we get this W bottom in here.